Okay, yeah, so thanks for the opportunity to read this paper. It's an extremely interesting and important question, both from a kind of policy perspective and from a kind of perspective of historical interest in China. There's an unprecedented expansion in the highway network, and I think it's crucial to understand kind of what that did. So, the paper uses an empirical strategy to instrument for market potential, market access. These seem to do largely the same thing, so I'm going to call them POTAC in the comments. And they have some results which are quite striking. They find very large effects on GDP growth from improved market potential in between 1990 and 2010. And they have, so this is for domestic market access, and they have slightly weaker results for foreign market access. And these especially seem to drive population. Interestingly, they have similar effects on prefectures and the central cities in a prefecture. I don't think Matt talked about this. And the effects are concentrated in the largest cities. And what's kind of particularly striking about these results is they're very, very different to the previous work that's been done evaluating the rollout of highways in China. And I think this kind of reflects two or three things. So in particular, it's including both urban and rural areas, whereas these previous studies have focused on the effect of transport infrastructure on rural areas. Secondly, they're doing a kind of a more complete job of allowing for the network structure of infrastructure, which is probably going to be important rather than just looking at whether a road flows through a particular location. And possibly the third thing, it's an IV paper, so of course I'm going to say that their instruments might be endogenous. And so I think perhaps some of the results are driven by this. And my second comment is going to be that I think the way that they're measuring changes in market potential or market access at the moment might not be the ideal measure. And I think from what Matt was saying, I think they're fully aware of this and they're kind of working on this for future iterations. But I think if you could calculate the measure of market access in a different way, this is going to help you resolve some of the identification issues that the paper currently has. So the main estimating equation is they're going to look at growth between 1990 and 2010 on various measures of internal infrastructure, domestic market access, and external market access in 2010, and they're going to instrument for these levels using the 1962 road network. And so the idea is that in 1990 the road network was essentially useless, and they document that there was basically no trade across the road network in 1990, and so the kind of level of the usefulness of the road network in 2010 is a good proxy for changes in the usefulness of the road network. So how do they calculate their instrument? Well, so this is what market potential looks like in 2010, and the instrument for it with the road network in 1962. With travel along the road network in 1962. And so I think Matt showed the picture of the road network in 1962. But even in 1962, the road network that they're using is pretty dense. Okay? And so if we overlaid a map of prefectures on here, we'd see that the roads pass through pretty much every prefecture, and most prefectures more than once in China. In their instrument, they assume that you can travel along these roads that I think is at 85 kilometers an hour. And so what you're effectively getting is some small variation on population density in 1982 or employment density in 1982. And the version of the paper I saw didn't have what the instrument looked like, so I tried to kind of recreate it myself, and it looks pretty similar. And so smooth population density looks pretty similar to what their instrument is. It's a bit hard to see, but you can see the kind of, try to use the same sort of colors. And so we can see we've got kind of these core China has high regional population density. And so why is this a problem? Well, their empirical strategy. And so this looks a lot like prefectural population density as well. And so their empirical strategy relies on this variation in what is effectively smooth population density. And the exclusion restriction is that conditional on controls, smooth population density in 1982 is only going to increase growth through changes in market potential between 1990 and 2010. And it just seems to me that there are a number of reasons why we might think this is going to be fairly unlikely to hold. So firstly, economic liberalization is extremely likely to have increased the value of being central. And so even in the absence of road investments, these core China areas are going to have better rail networks, which I guess you're planning to exploit in the future. We know they already had denser population. And even though the roads weren't very much used in 1990, this doesn't mean they wouldn't become used under a kind of more marketized, as the economy became more marketized. And so it seems likely that the existing infrastructure would potentially is also going to be more dense in these areas, and this higher density of infrastructure is going to become more valuable during the after liberalization. So this is going to potentially contribute upward bias. Secondly, we've got the unwinding of several Soviet socialist-era policies, and so in particular there were kind of policies for provincial and prefectural level self-sufficiency during the communist era. There were large provincial barriers to trade, and there was earlier than this is the kind of third front program, which resulted in massive investment in peripheral China. And so as these policies were kind of more or less abandoned, their abandonment is going to relatively constrain growth in peripheral areas relative to core areas. And so again, I think this is likely introducing some upward bias to their estimates. And the controls, I think, in my view, they control for population, manufacturing share, education, and elevation and slope. And I think these are unlikely to be sufficient to overcome the bias introduced by this correlation. So the second thing is, I say mismeasured, but the changes in market potential that they use, changes in market potential just from roads. And so they assume zero market potential from roads in 1990 and full market potential from roads, and then the market potential for roads in 2010 is the change in market potential. And then kind of implicitly, they've assumed that there's this additively separable property of market potential, so market potential from other sources, and that and that there's no change in the market potential from other sources. Now, I think it seems likely that the change in they document that there are limited changes in the rail network in between 1990 and 2010, but the infrastructure network is a network, and so the presence of roads is going to interact quite profoundly with the presence of railroads and other forms of transport. And so it just seems extremely unlikely to me that the implicit additive separability that you have to assume to estimate an equation of their kind is the right one. Now, fortunately, incorporating this kind of non-additive, if you incorporated market potential through roads, this is going to provide you with a potential instrument through railroads. This is going to provide you with a potential instrument for changes in market potential, exactly as Rick and Dave do when they look at market access in the US. They use the presence of waterways and market potential from waterways prior to the rollout of the railway network as an instrument for changes in market potential due to railroads. And in China, it seems like you could use market potential through the rail network as an instrument for changes in market potential, in total market potential, if you incorporated the two measures. And as you guys already have fantastic data on the rail network to go with your fantastic data on road networks. So, and by the sounds of it, this is something you guys were already working on. And so it seems like this would introduce variation in market potential that was kind of, to some extent, orthogonal to this kind of big regional variation in market potential that you might be capturing at the moment, and it's going to allow you to kind of control for regional specific factors much more satisfactorily, I think. So that was all I had to say.
Thank you very much.
Do you have questions? Do you want to respond to Sam's comments first?
Sure. So first, thank you for the very thoughtful comments. The point about yes, this is an IV paper, and we need to be more careful about selling the exogeneity or the exclusion restriction. I agree. I think your points are well taken, and probably at a minimum, including regional dummies is a sensible thing for us to do. And we will think about the strategy with railroads. The additivity of other networks is something we're going to deal with as we start treating market potential associated with rail. But I note that in the structural version, that actually comes out of the model. Right? So we cheat a little bit, but not very much. But that comes out of the model. So I think we're better on that than so we can talk about that later. But point taken. So really that's all. So yeah, point all. I agree with most of what you said, and thank you.
It might be useful to link this with the fiscal and growth strategy, especially in the 1990s. You recall that the fiscal reforms were aimed at concentrating resources along the coast because the connectivity infrastructure inland was not adequate. Therefore, the resources were given to the coastal provinces and the coastal hubs. The main cities were built up essentially because the export orientation could not be handled from within, and this has led to 20 years of very significant growth. But it's also led to 160 million people moving from the interior to the coast. It's a floating population, and the capacity of the coastal cities now has been exhausted. And if you look at the new urban hubs strategy, is to move back the production hubs into the interior to address both interpersonal and spatial inequalities, and also to better handle the linkages within the prefectures. So really what you've had is 20 years of re-engineering of the transport hubs, but the new hubs haven't actually taken off yet. So have you linked it? Have you seen the new urban strategy?
I completely agree with what you're saying, and that is why we control for distance to the coast in all of our regressions and capital city status as a way to start to pick. Remarkably, leaving distance to the coast in or out of our regressions doesn't matter. So as important as those phenomena seems to have been, they seem to be unrelated to the thing that we're estimating. Right? So yeah, that's a good point, but I think statistically it doesn't seem to be relevant. At least that's what we're finding. So now you might conclude from that you want to ignore everything I'm saying. But we're doing, we're aware of that, and we're trying to treat that by including this distance to the coast dummy, which I forgot is actually partially a response to Sam's comment about regional variation. But it doesn't look like it matters.
Right. I should say that there are lots of concerns like that, and that's one of the justifications for trying to instrument for these things, right? So you're trying to pick out sort of random variation in these treatments, and that's not correlated with any of these other types of things that are going on. And but we do find that there was big population growth in these coastal areas that were adjacent to ports that were targeted as FDI zones, and that kind of matches the narrative that you give.
Just two points, and one of which I'm repeating something I think we talked about it at the meeting, but I want to repeat it in this audience as well. So the first point is that fundamentally because I believe in the model that was presented in the previous thing, that productivity goes with population unless, we have very severe restraints on housing. I'm fundamentally not persuaded that this thing can be really having an impact on productivity and not having any impact on population, unless you're telling me that Chinese housing supply is vastly more constrained than I actually believe that it is. The second and far more important point is that if you combine, if you buy the market potential results, and this is where I'm repeating myself relative to it, and your work on roads and highway rays, roads and railways, having basically no effect in those regressions, you come up with the combined view that A, market potential and transportation has the capacity to be enormously transformative, but B, the marginal highway in China is worthless, or the marginal railroad in China is worthless.
Can we do these one at a time?
Sure.
If you give me a big list of questions.
No, I'm not giving you a big list. That's the only point. No, I'm not sure that that's actually the right way to interpret that. But
So on the second one, that's consistent with what we find here. Roads within cities with local infrastructure, we're finding doesn't matter, as we found in our other project. The thing that matters is connection to things that are nearby.
So if you do a raise,
look at trade flows in the U.S. If you look at sort of pairwise shipments within the U.S., it's all within that kind of distance, right? So that this decay rate is really fast. So what we're doing with these roads is basically opening up Chinese prefectures to have the same sort of trading region as U.S. cities have. So yeah, these are big effects. Maybe we're picking up something else, but really before there were dirt roads and now there are paved roads and trucks. And if there was going to be a case where this was going to matter, this should be it.
But then I misunderstood something. The roads regressions I thought were also just similar to the QJE paper, that we were getting highways. We were getting a highways regression result, and that I thought showed a zero coefficient. Is that in this paper?
On growth.
On growth, yeah. I thought that was what. Is that not? Then please clarify the empirical point on that.
What we had before, what we find is that radial roads change the configuration of cities. All right, is that they cause cities to decentralize. All right, within the prefecture. So the unit of observation is different. Right? In the other paper, the unit of observation is the prefectural city, and as you put more roads into the prefectural city, it spreads out. Right? This is different. This is what happens to the level of activity in the whole prefecture. Right? And we're finding that there's no effect, which is consistent with the results in the other project.
Yeah, but that's okay. Agreed. Then we are where we were originally, which is that the marginal effect of the extra road
depends where it is.
So I think the statistical response is that there's a very low correlation between the radial kind of infrastructure that's in one regression and the amount of market potential that new roads are connecting, right? And so I think you're thinking that you build a radial road and you're going to connect to lots of stuff outside, and that's true on the margin, but actually statistically the correlation is pretty low.
Was exactly my original point, which is that in fact the marginal effect of the roads in the roads regression, right, is modest, is zero or something like that, and the market potential effect is huge. Right, that was my point. My point was not at all that this was in some sense a logical impossibility in any way, shape, or form. It is that in fact it's suggesting the fact that the extra road on the margin isn't connecting to a lot. Right.
Yeah.
And that's the point. Right. That was the point of my original comment. That the marginal road, which suggests that and I think this is a huge warning point for countries more generally investing in infrastructure, which is that even if you take the basic point of half of this paper being that market potential can be really powerful, it is also quite possible to build a lot of roads and rails that connect to nowhere and get nothing out of it. That was the point of my comment that I thought.
In which case, I completely agree with you.
Thank goodness.
This question arises out of a rather primitive understanding of new economic geography and so on. I believe that as transport costs go down, some regions will lose out and others will gain, and the judgment at the end of the day is that overall you've won. I couldn't see in what you were presenting which were the regions that had lost out on this. And is that sort of supplementary to that, because I'm a bit of a feet on the ground chap, what do the traffic counts show on the roads that have been built? I mean, are they being used, and which ones are being used, and how much, to sort of help support the conclusions you're reaching?
Where are the losers is we haven't really done that analysis yet. You saw a little bit of that in one of those regressions, which is to the extent that there are losers, they are the places that are not the rank 1 cities. There are smaller cities that are getting better connected. One, I think, could, on the basis of these results, argue that those places are losing maybe a little bit. We don't have traffic counts, but we have looked at trade flows, and what you see over this time period is a big shift of freight and manufactured goods onto trucks from trains, and the distance of the average truck, the distance of an average truckload of freight increases. Right? So these roads are being used in a way that is consistent with this trade model, which is they're shipping goods back and forth within these regions. Right? And the distances are in line with our 6-hour, with going from traveling just within the prefecture to traveling within our 6-hour rings. Right? The data is very crude, so I can't do very well with that. It's like traffic counts for China 20 years ago, like really. But the best we can do, that's the best we can do. Right?
Anyone? Thank you very much.
Thank you.
We have managed to find ourselves 10 minutes. And so I know everyone is a little bit scared of the 7:30 finishing time. So if we come back at 10 to 5, we can keep that 10 minutes and maybe finish a little earlier as well.